Hello everyone and welcome to today's session, Inside the Numbers, a close look at IANA's intermodal market trends and statistics, the first in a new series of webinars from IANA. There are a lot of exciting things on the horizon here at IANA, including a full calendar of webinars, so stay tuned. I'd like to introduce today's presenters, both from IANA member TTX Company, Pat Casey, Vice President of Fleet Management, and Peter Wolff, Director of Market Development. I'm Hal Pollard, the Director of Education here at IANA. Today, we're going to be talking about IANA's Intermodal Market Trends and Statistics Quarterly Report, what the report's all about, and an explanation of the format and content, including the sources. We'll have an economic overview, look at the latest IANA numbers, take a peek at the International Intermodal Review, and open it up for questions. For those of you just joining us, welcome to Inside the Numbers, a close look at intermodal market trends and statistics. Now, let's get started. I'm going to turn it over to my colleagues Peter and Pat, and take it away, fellas.
Welcome to everyone. We'll start by going through the Intermodal Market Trends and Statistics report and showing you the value of that report. So the layout of it is it includes IMC, and I think everybody knows what that is, but it's intermodal marketing companies, rail intermodal statistics, and trucking industry data. And most importantly, it includes both analysis and the numbers, so that combination we think is a very good value. And it also has a standard set of charts in the report, and we'll go through that lets you know what's going on in the industry in a great deal of detail. Also included is some economic analysis and reports on the forward look of the intermodal industry and what's going on in the industry in terms of capacity improvement, service enhancements, and things like that. So the first section is quarterly rail volume results. So it compares to last year on a year-to-date basis as well as for the quarter. Breaks it out by the three major components. A little bit of overlap between those three, but mostly very distinct segments. And then in that last chart, you'll see it breaks it out by size of equipment as well. This one covers all of North America. One of the very good news stories recently, last few years, is all of the major North American railroads are reporting, including those in Mexico. So that gives a great deal of detail about the industry. Next section is key corridor and regional traffic results. And the regional breakdown is very, very helpful in understanding how the industry is trending. No other data out there has anything but a total for a railroad, where this gives you a breakout by geography that really helps to understand where the industry is going. So this analysis looks at the major corridors and breaks them down bidirectionally, looks at what the segments are that are driving each of those corridors and how they're changing year over year. Next, we show seasonally adjusted volume, and I think most of you know what the term seasonally adjusted means, but this is a good way to look at trends, and sometimes even better than year over year. Think about early 2016 compared to early 2015 when you had all the port issues. Those year over year numbers didn't mean much, but a seasonally adjusted number really gives you a better view of things in that area. So we think it's very important to include. The next section is the IMCs, and a great sample of the domestic intermodal market gives you details on both the IMC's intermodal and highway business, both loadings and revenue. And that's the other important part of it, is this is one of the few publicly shared databases that has some revenue information as well. So that gives some good market feedback as well. The next section looks at long-term trends, gives a really excellent perspective on where things have been going over the last 10 years, not just in the recent quarters. It looks at volume by equipment type in the major categories, domestic and international. Looks at major lanes, north, south, east, west, the transcon lanes, and also at length of haul, which has been a very important trend, and you can see in the long term going down, but turning up a little bit of late. So a good long-term perspective on the industry in this section. The next section is the Intermodal Outlook, which is a written analysis of where the industry has been and is going in the near term, what the expectations are for changes in growth in the various segments, forecasts provided for domestic containers, international, and trailers, and also some information about the major railroads, has their financial results, and also some bullet points about some, as we mentioned, capacity expansion, service enhancements, things that the industry is doing to keep intermodal growing and improving. The next section is the trucking industry outlook. This is provided by FTR, which is a major analyzer of the trucking industry. They do very well at explaining what's going on there. And of course, this is extremely important because the trucking industry is by far the biggest competitor to the intermodal industry. So it looks at volume growth, looks at utilization, sales, driver labor availability, great deal of data on that industry. Whether you're in trucking or whether you're in intermodal, helps you understand how the competition is going. Next section looks at quarterly data and statistics for economic indicators in each of the 3 North American countries, and a detailed analysis of that as well. And it's very important to understand the economy. That is a key driver of intermodal volume. Certainly, the industry can go after more share, improve service, offer new services, but the economy is a major driver of the base business, and very important to understand how it's going, to understand where intermodal is going. Then there are 12 pages of highly detailed statistics for each region, looks at the major lanes between that region and others, looks at it month by month for the quarter where it's reported, and then also quarter over quarter. So a great deal of detail, help you understand very well if there's a particular region that your business is part of, it helps, or that you're competing with, it helps there as well. So great information in those 12 tables to give you a deep dive into where the intermodal industry is going. Then the last piece we'll talk about is what's called the ETSO, Equipment Type, Size, and Ownership, which is a historical data file. And that includes all of the detail of region, equipment size, equipment ownership, which is whether it's owned by a railroad or privately by another container or trailer supplier, has data by month over the 5-year period. This is a highly valuable research tool for intermodal as well. You can go into that data and cut it any way you want to help you understand what's going on in any very specific segment. And this is, again, so much more detailed than any other data source that's out there about how intermodal data is flowing. So we'll move briefly on to the economic overview that is driving our look at things. Growth in GDP did improve in the third quarter, up to 2.9%. The weakness early in the first half was falling investment, oversized inventories. That corrected a little bit in the third quarter, and we'll have a chart about that. This is always a fun day, the election day, to talk about the economy, but certainly, without taking any sides, there is a rising level of policy uncertainty going into an election, which drops off once the decisions are made. That uncertainty can hold things back, so should change a little bit after the election day. The labor market has been very solid. Consumer spending growth also has been very good, and as a result, in particular, of better jobs, better wages, lower gas prices, it's really helped with all that. Housing market continues to improve gradually. The manufacturing market is a little shaky and has been fairly flat. Of course, that is a very important source of freight, and you'll see that in some of the data. And recession risk is up just a little bit recently. And I think the big issue, of course, ahead after the election is when and if interest rates go up again. So if you look at the next slide, this shows a breakout of GDP by quarter. And you can see that investment and inventories and exports had dragged GDP lower for the prior 5 quarters. Turned back around in the third quarter of 2016. In the initial report, that can be changed, and got things up to a more positive level. Consumer spending is the blue chunk, and that remains very solid. Inventories went up, and government spending also improved in the third quarter, which is also a driver of GDP. So that gives you a very high-level view of where the economy is going. More detail, of course, about that in the report, and would urge you to read that. So with that said, I'm going to turn it over to Mr. Wolff to walk through the latest IANA numbers.
Thanks, Pat. Given the significance of the day, I'll just add that all these numbers are actual. It's not a poll of what we think. So we have a few slides on the numbers, and then we'll do a little bit deeper dive in international intermodal. Year to date, which would be the year through September, domestic container growth remains pretty strong, especially relative to long-haul trucking. International intermodal is down, however, and as I said, we'll have a little bit more discussion of that a little later on. In terms of regional growth, all the regions seen solid domestic loadings The eastern half of the U.S. seems to be doing a little bit better than the west because they have less international intermodal. And the Canadian and Mexican volumes seem to be affected by international as well as a weaker economy in those two countries. And this cuts the data a little differently. The prior slide I just showed you was year to date. This is simply looking at third quarter of this year versus third quarter of last year. But the story really doesn't change from the prior slide, that domestic intermodal is doing pretty well, growing 3.3%. Which is pretty good considering the low fuel prices are really helping their competitors, the trucking industry. Trailers are down quite a bit. This is really results more from the decision of the Norfolk Southern to change their strategy on the road railer traffic. So that's down quite a bit. But it isn't just that. I think that the low fuel prices are dragging some trailers away from the rail as well. So all domestic equipment is down about 2.3%. The international side, it's down quite a bit, third quarter, down almost 7%, for a total of being down 4.6% when all the segments are combined. Trailers, domestic containers, the 53-foot units, and then the international containers. Looking at loadings by region, again, pointing out that all the regions will be affected negatively by the trailers. But in addition to that, some regions have a little bit else going on. So in the case of Eastern Canada, the first line on the top, that's being affected by a little weaker domestic container volume. The same is true in the Mountain Central region. Domestic containers are down. Midwest, losses there are due more towards international volume. Same is true in Mexico. Declines there are due towards international intermodal declining. Northeast, volume is up a little bit. Be driven by international volume and some all-water traffic, which we'll talk about. Northwest volumes are doing pretty well. That stems from, I think, some good service improvements on the Burlington Northern Santa Fe. They've added a lot of capacity, dealing with a lot of fracking business. That business, part of that has gone away, but the track capacity is still there. So pretty good train speeds, and that's helping to drive some volume growth in the PNW coming into other parts of the country. South Central, that's a decline in international. Southeast, declines are driven more towards trailer volume. And then the Southwest is down due to more international volume, as is Western Canada, and weakness in the Canadian economy is holding back some international volume growth. Looking at the next slide, the top lanes, Western Canada Midwest showed some pretty good growth, and that has to do with international volume. I just mentioned that volume was down in Western Canada, but this is volume coming into Western Canada, coming into the U.S. Midwest. And I think most people listening on the call are familiar with the port labor dispute on the western U.S. that occurred last year, and some shippers have diverted cargo to other locations, and we're seeing the result of that in the growth of Western Canada and Midwest lane. Northwest to Midwest, again, is growth both in international and domestic segments due to higher service levels in that corridor. Southwest to Northeast is showing some growth, which we believe is due to transloads, which we'll talk about what transloading is in a couple of minutes. Northeast to Midwest is international due to all-water traffic coming to New York and Norfolk, then routing inland by rail. Intra-Canada, that might be up to a little bit of domestic volume, and Eastern Canada up 0.4%. That might be a little bit due to domestic volume. Next slide, which would be the decline lanes. And again, most of that is due, or a fair number of that is due to the trailer volume. South Central to Midwest, domestic containers as well as the trailers. Intra-Mexico, that's more domestic volume, as we saw that's the international volume declining. Midwest to Southwest, which is the reverse of the South Central to Midwest. Again, that would be the same trailer volume and domestic containers. Intra-Midwest is a little bit loss of domestic volume. And then the last two, Southwest, South Central, and South Central, Southwest, that's a nice segue into our international discussion. So volume is down in those two lanes, primarily due to increased all-water service. Steamship lines have added service to Houston through the Panama Canal, and that's reduced rail traffic from the Pacific Southwest, Port of LA Long Beach, into Texas. And we'll talk about all those terms in the next few slides to bring everybody up to speed or on the same page in case you're not familiar with the terminology. So let's talk about international intermodal for a second. So let's just define international intermodal. International intermodal is we define it as the marine container routing inland. So the marine container, that's the 20-foot container, the 40-foot container, and the 45-foot containers that are all owned by the steamship lines. And when those route by intermodal, by rail, inland. We call that international intermodal. But it goes by a bunch of other names that you might be familiar with. Sometimes it's referred to ISO traffic, ISO, or International Standards Organization. Sometimes it's referred to as IPI, Inland Port Intact. So it goes by a bunch of names. I'll try in my comments to keep referring to it as international intermodal, and I'll try not to slip into another vernacular. But if I call it something else, you'll understand what I'm referring to. So when we look at this slide, it tells a bit of an unusual story that in all other years, when imports grow, then international intermodal grows with it. Maybe not necessarily at the same rate, but the signs are always positive. And conversely, if imports decline, for example, in the recession year of 2009, international intermodal declined as well. But this year really doesn't fit all other years that imports are growing at a fairly good clip, about 3%, but international intermodal through the first 9 months of the year is down nearly 4%. And so we're trying to understand what's causing all this, and it's probably one of three factors. Increases in all-water service, we'll talk about in a second, increase in transloading, and increase in truck competition. If we flip to the next slide, we can talk about all-water share. So again, just to make sure that people are familiar with the term, all-water share refers to containers that originate in Eastern Asia, China, Japan, Korea, and Vietnam that route to the U.S. East Coast. And sometimes this is reported as a volume, sometimes it's reported as a percentage. The vast majority of containers route to the U.S. West Coast. That's simply the shorter route. It's typically faster. But there's been a growing share over time of all-water volume and percentage to the U.S. East Coast. In 2014, prior to the labor dispute on the West Coast, all-water share was about 30.5%. Today, it's running about 33.6%, so almost a 4-point gain. In 2015, it had reached almost 34%. It's fallen back about 0.3% in this year, but relatively small amounts have fallen back. So it's loss of 4 points of share, and I think that's why we're seeing a good chunk of a decline in the IPI, or the international intermodal volume, over the past year or so. The other reason for declining volume are transloads. And again, just to make sure we're on the same page for definitions, transload is when a product comes in a marine container and then is transferred into a 53-foot container or trailer and then routes inland by rail. And there are a couple of reasons for this to happen. One, you might have some transportation savings. Instead of shipping 3 containers inland, you ship 2 containers. Another reason to do it is it helps reduce logistics costs and reduce inventory carrying and increases speed to market products. An example of that, I was lucky enough to take a tour of a transload facility in the West Coast earlier this year. It was right around the spring when a lot of seasonal goods were coming in, barbecues, lawn furniture, utensils to cook with on the barbecues. And it was pretty neat. It was a long warehouse, what you'd expect for a warehouse building. And on one side were bunches of 40-foot containers, and in one 40-foot container would be all barbecues. In another container, it would be all utensils. And then on the other side of the warehouse were 53-foot containers lined up. And inside of those were going a mixture of the barbecues from one imported container, wicker lawn furniture from another. And so you were building containers to go directly to stores right at the port, rather than sending one container of barbecues to a store, which was far too many barbecues for that location, or sending the international container inland to a warehouse and then reshipping the goods from there directly to a store. So I think it's sometimes referred to as DC bypass. But in any case, there's a lot of value that's provided to the shippers through transload. And you can see on the chart that over time, transloading has grown, which are the red bars in terms of volume in the Pacific Southwest, which are the ports of LA and Long Beach, and the yellow bar, or the yellow line, which is the share that gets transloaded. So again, the transload share is relative to the import volume. So when we say 34% of goods are getting transloaded, it's an estimate based on the IANA data and the import volume coming in. And we're very fortunate to have the IANA data that allows us to make these comparisons. So it's pretty neat. And not only can we do it in the Pacific Southwest, but we can do it in the P&W as well. And again, it's the same trend where transload volume is increasing, as is the share. And part of the reason for this is it seems that everybody likes transload. And when I say everybody, it seems that the steamship lines don't object to it because it allows them to keep their marine container on the coast rather than have to route it inland and they lose control over it. The transloaders certainly like it. It's how they make their living. The firms that handle the freight in the 53-foot units seem to like it, whether it's a 3PL, managing logistics, or a trucking/intermodal company, Hunt, Schneider, Swift, Hub, firms of those nature. They like the transloading. And the railroads seem to like it as well. Either they're going to handle it in an international container or they're going to handle it in a 53-foot unit. So nobody in the supply chain seems to object to transloading, so it continues to grow. And I think it explains a lot of why the IPI volume has declined. And then starting to wrap up, I think that the yellow bars show the percent, the international intermodal share of import volume. Again, we're combining data from IANA with data from Piers, which is the company that reports the imports. And you can see the yellow bars have trended down for a long time, since 2006. And that is a function of transloads and a function of all-water share growing in this same time period. But the blue line is actual volume, and but for the recession year, volume has pretty much grown in every year, volume meaning the number of marine containers routing inland. And what makes 2006 such the anomaly is that 2006 the volume declined. I'm sorry, 2016 volume declined again. So again, it's a little bit of a riddle, and so it's a combination of transloads, all-water share, and this year intense competition from trucking is drawing off some of that international intermodal volume.
So to finish up with a view of the industry and where it's going, it's been a tough year, no question. There's never been the 2 consecutive negative quarters outside of a recession, but we are in a freight recession, no question about that. And Peter's given you a lot of detail, a lot of reasons driving the international market lower. The trailer market falling as quickly as it is kind of a one-off, and that should turn back around. It's likely to be flat to down full year for 2016, but things are likely to turn back up next year, in particular as trucking regulations start to tighten up in the second half of the year. That will be very important to it. Fuel prices, if we're right, tough thing to predict, but if they do trend up a little bit, that helps as well. And most important, as many of you know, the railroads are being hit very hard, in particular by coal, but a number of their other carload segments are declining as well, and will need to flatten out. Maybe some will turn back up, coal unlikely to do so. So the railroads are really reorienting their networks, they're reorienting their workforce, their technology, and it is very, very much focused on the intermodal world. That is the number one way for them to recover from where they are now with a very difficult year and all of that slowing carload business. So we do expect a positive growth next year and accelerating growth after 2017. So while it's a tough year, the future does look much brighter for the intermodal segment. So with that, we'll wrap up our comments. And Hal, I think time for questions.
That sounds great, gentlemen. We've got a good list of them here for you. So why don't we just go ahead and jump in. Pat, you mentioned that the likelihood of recession is kind of low, at least currently, but what do you think might trigger a recession in the future?
Well, you could, I think a couple things. Often it's a bubble that causes that, like we had a housing bubble that caused the problem in 2009. One of the things to keep a close eye on, which is somewhat related to our business, is the commercial real estate market, in particular the warehouse market, which is driving up greatly. A lot of that's e-commerce related, but is that too a bubble? That's probably the strongest place right now. The other thing that we keep a close eye on, and many of you may be familiar with, is what's called the yield curve, which is the rate of interest at various levels of maturity. And if that flattens out too much so that long-term interest rates and short-term interest rates are about the same level, that is by far the best indicator of a recession. What will be very interesting to track is when and if the Federal Reserve decides to raise interest rates again, and they, of course, control short-term, not long-term interest rates. How will that yield curve shift? And if it does shift, will that drive the risk of another recession? And then there's always the kind of one-off thing. To give you an example, in 2001 we had a recession. There's some debate that maybe without 9/11 there wouldn't have been a recession in 2001. So some kind of one-off thing like that can also cause it. So we think it's a relatively low risk of a recession right now, but always something to keep an eye on. And it is also a very long recovery, although a slow one, and that's probably going to make it last longer than some of previous ones where growth was going more quickly.
Got it. Well, let me throw out another one here for you. You mentioned that you use seasonally adjusted tables in the report. Talk a little bit about how you put those together.
Well, there is a statistical model been produced by the federal government to do seasonal adjustment to any set of data that you have. And what it's doing is taking out what the normal seasonal ups and downs are over time, so that you know what the underlying trend is. So, for example, for intermodal, the peak volume is almost always in the third quarter of the year. Peak is not as sharp as it used to be, but it's still there. And that seasonal adjustment that we apply to both the international and the domestic segments takes that normally. So if you normally go up 8 to 10% between the second and third quarter, you take that out and see what the underlying trend is doing. So that's a very helpful way to look at it. And that tool is available in many different areas online if anybody wanted to grab that.
On a related note, do you feel the election results could impact recession concerns or economic recovery?
The one thing I will raise as an issue that is of a concern to our industry is that there has been opposition to trade across the political spectrum this year, and trade is a major driver of the intermodal business. The international side is more than half of the intermodal business, and then you add those transloads in, which are driven by imports. That's a big part of it as well. So that's probably the biggest thing that I would worry about, is if, in fact, those things that have been talked about in the campaign to stop trade with China, to stop trade with Mexico and Canada, or to maybe not stop it, but to restrict it, could be a little bit of a threat. The other interesting thing, I think, remember, we're the Intermodal Association of North America. When we say domestic, we actually include stuff that moves across the Mexican and the Canadian border. And I'm not defending that, but that's just a habit of what we've done as an industry. So that tells you how important that trade is. So I think that's the biggest thing from the intermodal perspective for us to keep an eye on after the election.
Here's a good question. Why has the growth rate of imports slowed since the end of the Great Recession?
I think we refer to that as saturation. So prior to the recession and going back to, say, year 2000, 1999, 2002 through there, you saw a lot of offshoring occurring. And when the factory was offshored, then 100% of the volume came back in 1 year, so to speak. So you're seeing some pretty strong growth rates, 8%, 12%. Of international imports. But after a while, there's only so much that could get offshore. Think of clothing, shoes, fabrics. Pretty much everything that could be manufactured offshore is being manufactured offshore. Toys, that sort of thing. So the import rate is then going to closely mirror consumer spending or GDP overall. So if that's growing around 3%, imports would grow around the same percentage. It does vary a bit. If housing is stronger 1 year over another year, there's a fair amount of imports that are associated with housing market. So it could grow a little bit better based on how that sector is doing. But it's generally pretty well saturated in that sense.
Questions relating to Steamship Line. Do our statistics include Steamship Line moves? And if so, how are they shown in the stats?
Yeah, the IANA data does not show how the steamship line moves it. And there are other data sources for that, but it does show the piece of their business that's moved inland by rail, or empty or loaded boxes move back to the ports.
As far as trucking, you talked about the role of trucking in the decline in the intermodal rail segment. Is this true at ports as well? Are more store-door deliveries using trucks only and not rail?
Yes, we think that is very much a factor. In particular, it's always been very truck competitive coming off of the East Coast ports because you're on a shorter haul. So if you're going from New York to Columbus, Ohio, that can move rail, can move truck, can vary quite a bit depending on trucking capacity and fuel prices. What's been very surprising recently is we're hearing anecdotes of freight being moved from the West Coast port to the Midwest by truck because there's so much capacity out there, so many empty trucks out on the West Coast that need to get back to the Midwest that are offering very, very cheap prices. If you'd asked me 5 years ago, I would have said, nobody ever trucks a container from LA to Chicago. They're doing it today, and that is that trucking capacity and the low fuel prices. So that should turn over time, but it is something that has weighed on the international side of the business for us.
Yeah, just to add to that, when we were looking at imports into LA Long Beach, running our transload estimates and comparing the imports to the IANA data showing the outbound moves of containers by size. So you can look at the international volume moving outbound from LA Long Beach as well as the 53s. The 53-foot volume is growing year over year, which is the transload growth. But the IPI volume, the international segment, has declined to the point that roughly 29% of the containerized imports in LA Long Beach moved inland by rail in the third quarter. And that is, I don't know if it's an all-time low, but it's a low over the last 10 years. Under normal conditions, you'd see something closer to 35%, 36%. And so the decline is partially offset by the growth in transloading, but there's still a gap, 3 or 4 points, and that gap is what we think is getting trucked to inland destinations.
Do forecasts show continuing upward trends in transloading, and would you anticipate the overall volume of international intermodal in the Midwest and South to decline due to these trends?
In a word, yes, but I think we forecast imports to grow overall. I think transloading IPI should continue to grow next year. I think Pat touched on that a little bit. Our forecast is for imports to grow about 4% next year, with international intermodal growing about 2.6, something in that range. So we would expect international intermodal to grow. Transloading may grow at a little faster rate than that, so a continuing share gain. So it's a little bit hazy, but we would say share declining for international intermodal, but return to sort of a normal growth year over year.
Can you speak to your view of incremental or new intermodal equipment demand for 53 and 40-foot designs specifically over the next 12 to 18 months?
Now you're talking about containers or rail cars? Is that clear?
Well cars.
Well cars, okay. Well, one other piece to the rail industry that we hadn't discussed yet is the increasing velocity and improved service that's going on out there, and that is because the railroads have reduced the amount of volume they're handling. Everything is turning more quickly. Think about it at wherever you may drive into work. If half the people go away, you're going to get to work a lot more quickly. In the rail industry, if that velocity improves tremendously as it has, you can handle the same amount of business with fewer rail cars. So because of that, and we at TTX are the main supplier of well cars, we do have quite a surplus right now. We probably will add a little bit to the fleet next year, but not much in the near term because that velocity is so strong.
Here's one, Pat. When Norfolk Southern restructured the road railer division into the domestic containers, why did the overall domestic numbers not reflect the substantial increase?
Well, they could answer that better than I could, certainly, but the question is, did any of those move to domestic containers? Did they stay on NS? Did they simply move to the highway? They can answer that question better than you. One thing I'll say more broadly is the trailer business in intermodal is a little bit separate from the domestic container business. It's very much focused on LTL and parcels, and the thought that, hey, you're just, when trailers go, it all goes to a domestic container, or flip it around. Lots of the domestic container growth is because trailers have transferred to containers. Some of that was true a while ago. I don't think much this year at all on a very broad basis.
Okay. Here's actually a really good follow-up to that one. Are empty international boxes being utilized for domestic repositioning moves calculated into the domestic or international IANA numbers?
For IANA, the numbers are based on size of the container. There certainly are boxes, containers moving back to the ports that are loaded with domestic freight. The data doesn't tell you whether it's domestic or international freight, so that's not necessarily clear. I think it's a relatively small share of what's moving to ports. is loaded, even with exports, because they're pretty weak right now, but in particular with domestic. Could that go up as the balance remains where it is? Certainly could. I know there are people marketing that, but I think a relatively small share.
Now that we're back on the ports, the report talks about the Hanjin Impact. How much does Hanjin and the general overcapacity and lackluster demand in ocean freight affect our IANA results?
Well, certainly the overall demand is weak, and that certainly affects results. Probably, though, the bigger share of the impact on results are the other things that Peter talked about that are reducing the share of imports that are being moved by rail. Imports over the last few quarters have been flat. International rail volume has been down significantly. So that's a much bigger impact on that. It seems that Hanjin, I mean, we don't have specific numbers for how much of that was a Hanjin container, but it probably distorted things a little bit over the months where they went into bankruptcy, ships were held offshore, containers then were moved in and unloaded, things were messed up a little bit in terms of operations. That probably tweaked things a little bit. Long-term trends, it shouldn't affect things much. I mean, somebody will replace Hanjin. It's really driven by the demand.
So you think it did affect our data this quarter?
It may have affected
a little bit. I mean, import volume in September declined just a tad year over year at a month where you wouldn't expect that to happen. And Hanjin is about 7% of the Trans-Pacific in terms of capacity. So you could see one line not being able, if they were truly unable to unload all their cargo in September, you could see how it could affect the numbers a little bit. We simply can't tell whether the ship docked and whether it was unloaded. It's just what we read in the newspapers. So you could see some potential. On the other side of the coin is we could have a pretty strong October, making up for what was unable to unload in September. It gets unloaded in October. We don't have the data quite.
The October data should be very soon. Yep.
Okay, last question. Are high inventory levels tied to the growth of e-commerce and the need for higher inventory levels to satisfy time-sensitive demand?
That is a great question because it's something we're doing research on now, both talking to the industry, doing some statistical analysis. We believe that it is true, that inventories may be permanently higher given the e-commerce structure that's growing and growing at a 15% rate, taking a bigger and bigger share, particularly of things like apparel or sporting goods or things like that. The inventory to sales ratios, those of us who have been in the industry for many years, for my whole career, it trended down. Post-recession, they've been trending up, and in our opinion, that most likely is because of e-commerce being bigger. To manage that business the way that you want to manage it as an e-commerce retailer, you'd need a higher level of inventory to be able to support what you're promising to your customers. So I do believe that it's likely that inventories will remain somewhat higher because of the e-commerce growth. I think we've covered everything to join everybody with this, and certainly if anybody would like to ask us questions afterwards, please send them in.
And that's a great segue. If there are any other questions, if folks want a little bit more information about intermodal market trends and statistics, the ETSO database that we talked about a little bit, or IANA in general, please visit intermodal.org or send us an email at info@intermodal.org. Everyone, thank you very much for your time and have a great day.